So good morning, good morning, good morning, good morning, good morning. Once again, we are at Thursday morning, 10 a.m. For our weekly broadcast by Leo Crowdfunding and Property Fortress. For the regular attendees, you know me by now, David Johnson, CEO of Leo Crowdfunding, equity property crowdfunding platform, and my co-host, Mr. John Corey. I'll let him introduce himself.
John Corey, Property Fortress, US UK real estate investor, buy and hold, but also much more focused on passive investing, which happens to be through crowdfunding, in the sense that I like having people bring me deals to look at, having this process, knowing all the paperwork sorted. It's it's a much easier way to go.
Excellent. And also joined today by Dal Ray, our investor portfolio manager. Good morning, Dal. How are you?
Good morning. Yeah, very well, thank you. Good morning, everyone.
Good to have you back on again. And I know you'll probably be in the hot seat next week, because I'll be either in an airplane or just off an airplane next Thursday. So you'll be holding the fort next week. And for today, let's remind everyone, sort of the housekeeping is the Q&A. If you want to comment, if you want to ask a question, particularly on today's topic, then put your comments or questions into the Q&A. Dal will pick those up and then put them to John and myself as we go through the presentation. So in terms of property market update, I've kind of linked together the property market update, our special topic for today, and also John's Ask John session. They're all kind of linked. So today, what I wanted to draw people's attention to was the fact that the FCA consultation paper 22-2, which was the second consultation paper of 2022, it actually closed a few weeks ago. So the consultation is now closed. And I know, John, you actually took part in the consultation. Certainly you've been involved in numerous sort of feedbacks and interactions with the FCA on these different consultation papers. Maybe just explain, first of all, the consultation paper process, and then we'll talk a little bit about what this means to the property market.
Okay, so I'm not close to an expert on how they run their process, but what I observed in particular for this series was there was the discussion paper where people could discuss some things, and literally they send out a document, you read it, you provide feedback. It's not a live meeting. And then we had some weeks after that, this consultation came out. So this is a formal request for comment. They're laying out certain things that they see concerns with, or areas for improvement, or topics they want to highlight and surface, and possible scenarios or possible strategies, maybe not explicit changes, but general comments. So they'll say, do you agree we should regulate this area more? Do you agree that this is well regulated already? And asking for more general comments than just yes, no. And I think in this particular consultation, there was 26 questions. And then after this, and what they allude to in the document, is they will come back with further action, maybe a policy statement or an update as to here's the results of the consultation. This is what we learned from consulting with people. This is where we think we're going. And in these specific areas, this is our now new regulations. So this consultations are required by law, and then they can come out with regulations. So they could very easily this summer, this autumn, come out with some new regulations in the specific areas that they consulted on.
Mm-hmm. And in terms of the big picture, you may ask, why is this relevant to property investing or property developers wanting to fundraise? Well, this particular consultation paper, as you can see, is all about strengthening our financial promotion rules for high-risk investments. Now, property investment, of course, sits within the high-risk investment category within the FCA designations. And they've also, interestingly, in this document, linked crypto assets. So the whole NFTs, tokenization of property investment, all of that word, John, has actually now been linked in with property investment for all intents and purposes.
So I wouldn't quite go that they linked it in with property. I would say that they clearly have reiterated that property is a high risk investment, unless it's just a buy and hold, no improvements, already rented, just collect the rent. That is the one category or subcategory in the niche that possibly isn't in the high risk bucket. What they are saying is that they don't see crypto assets as being terribly different, that if you're going to buy tokens or NFTs to evidence an investment in something else, that logically is going to be treated as if it's a share or some other representation of an investment. They did highlight quite a bit that they're not announcing specific rules here because the Treasury was going to be publishing information on how the Treasury views crypto and the related fields. Treasury has subsequently done that. So the FCA was ceding the ground that we will follow the Treasury's lead. We will be communicating later in the year about what we might do in the crypto space. They did come down very clearly though on they will probably ban all refer a friend type promotional activities, even for crypto, that if it's an investment product, we don't really allow this referral introducer type mechanism in a broad sense, particularly for the retail investors. So why would we do it for crypto?
Mm-hmm. Yeah, no, that's a good point. So if anyone has any questions on this or anything that's been said, put your questions into the Q&A and Dal can pick those up. Now, John, you mentioned that through this document, and I really encourage if you're involved in property development and you want to raise funds, from investors, or you're an investor looking at different ways of investing money in property, I really do recommend and highly encourage that you go on this document, the links there, and have a read through it, because it is really important that you understand, if you like, the environment, the market that you operate in. 4 questions I picked out, John, really just to highlight, if you like, the trajectory or the areas of focus that the FCA have in this document. I mean, the whole area of sort of mass marketing to the restricted retail investor is clearly a focus. They even talked about, for instance, putting up a pop-up risk warning for first-time investors. I don't know if you have any particular thoughts on that, or any other things that they be recommended or are considering by way of trying to protect retail investors.
It's a little hard for me not to have comments when you offer the opportunity. The first one in particular is about creating positive friction, as they call it. They want to see physical steps forced onto the investor to slow them down so that they don't quickly go click, click, click on a smart device and they're in. Whether that's a pop-up, whether that's a paper document, if you're doing this in a physical office with face-to-face. So they're looking to get new investors to be shunted over onto the slow lane or into a lay-by or something where they have to pause for 2 minutes or read a document or sign something, so that the investor is repeatedly warned that they could lose their money and that this isn't a rush to get in before all their friends.
Mm-hmm. And yeah, as this gets rolled out, it's only going to go one way. There's only going to be more, if you like, checks and balances or hurdles or hoops to jump through for particularly retail investors. Now, we'll take questions.
I would suggest that that's true, but what is interesting is the crowdfunding platforms who offer equity largely already do many of these things. They don't necessarily do the 2-minute timeout, but it's the peer-to-peer platforms that are struggling more, and many of the peer-to-peer platforms have pulled out of the dealing with retail investors off the back of a series of these changes. And what you'll see is this document also is trying to address, say, I'm trying to raise money for my deal versus I'm working with an advisor or a platform who's signing off my raise. So what does the platform have to do versus what do I have to do? And that is where a lot of the dividing line is. Yeah.
And we'll have a few more things to say on the peer-to-peer market, obviously, in a few minutes. Dal, just to bring you in this one, because on the question 6 of this paper, they talk about potential changes to investor declarations in terms of restricted, high net worth, sophisticated investors. And obviously, as our investor portfolio manager, you're, if you like, at the coalface dealing with investors, and very often you get asked, well, what category am I in some cases, or high net worth individuals, what exactly is the certification process. So have you any views on sort of the FCA maybe looking at these three categories?
I mean, the feedback that I got from investors would suggest simplifying the declaration, in particular for kind of first-time investors who are not familiar with the process of investing on a compliant platform, unsure what certain wordings mean, and referring to what articles, etc. So I would say at this, from the level of feedback that I have received from investors, first-time investors in particular, simplifying it would probably be a lot easier for them.
Mm-hmm. Yeah, and even the whole designations, the interesting one regarding crowdfunding, we haven't time to delve into this today, but a sophisticated investor, there's a very clear criteria for becoming a sophisticated investor. And by investing in 2 crowdfunding deals, that actually makes you eligible to be a sophisticated investor. So there's actually a pathway, there's a route for retail stroke restricted investors to actually become sophisticated by simply investing on deals on a platform, which is very interesting in that. John, but number 8 there is just regarding, again, maybe this closer scrutiny of what's required, particularly for the marketing to the restricted investor in terms of mass marketing, I suppose, with social media, email blasting, all those sort of things. And really the FCA are just wanting to put in, more checks and balances for how that market is targeted, and obviously, well, induced is the wrong word, but given the opportunity to invest in what the FCA say is a high risk asset.
Yeah, and I'm not going to split hairs with induced versus on opportunity. I think many people are using inducements. What this point is about is the need for better record keeping, both the individual raising the money if you're going direct, or the platforms and supervisory entities who signed off, if they're an FCA authorized person, to sign off promotions. And they want ongoing checks to make sure that there haven't been material changes, so that what was signed off is still valid. They want the firms to have confidence in what they're signing off. So my general analysis of this, and to everybody who's a property investor rather than an FCA expert, there's no money in compliance. The money is in your deals. Outsource the compliance to an authorized party. Let them handle all this stuff. You need to focus on finding your next deal, getting the project done, getting the materials on site, finishing, selling, whatever it is that you do in your property space. There's absolutely no money in this. This is an overhead, and let someone else pay the insurance and all the other things that need to be done so this can be done well.
Mm-hmm. And we're highlighting this because this is relevant, up-to-date market news, market information. I've linked the far side there on this slide, just the 7th of April, just a week or so ago. Catherine Gaw, peer-to-peer finance news, big article, how the FCA vows to intensify, which is quite an emotive word, to intensify supervision of principals and ARs. So make no mistake about it, the FCA has a keen interest in exactly what's happening within the crowdfunding market, particularly in the peer-to-peer debt space, which brings us on very nicely to our topic for today, which is what is next for peer-to-peer crowdfunding. Now, obviously, reminding everyone, I'm sure everyone is well aware, there's the 2 different types of crowdfunding. There's equity crowdfunding, which is what we are, a number of other platforms in the UK, and then there is peer-to-peer crowdfunding, which is debt crowdfunding, where effectively it's loans with security been offered on behalf of 3 platforms to fundraisers. Now, why is this question been asked currently? Well, following on from what we just talked about, FCA scrutiny, the whole focus on making it, I don't say more difficult, but making it more of a thoughtful process for investors to invest, and having to be clear that they understand the nature of the investing. If you look at what's happened just literally in recent weeks, and a few months ago, but this is what Financial Times, just the 6th of April, referring to how Funding Circle, they exited the peer-to-peer space, one of the big giant players, and they refer to regulation and this increased scrutiny by the FCA and all these hurdles we've been talking about. And they just decide, you know what, we're out of the space where we're not gonna deal with retail investors. So that was a big shakeup of the market, if you like. Zupa a few months ago exited the market. You then had Future Bricks decided to exit the market in terms of offering a regulated offering to retail investors. And even for those of us who know what's going on with Crowd Property, they've launched their Crowd Property Capital. They had about a 300 million institutional line coming into the business to fund deals. And I think clearly the trajectory is that they're not relying as much on the crowdfunding side. They're really becoming just another type of lender with a big pot of money in the background. So John, this is the reality of where we are. Yeah. So over to you.
So the lady on the far left is the CEO of Funding Circle, and they're not exiting the lending business. They're exiting the funding side of that by they don't want to use retail investors going forward to fund loans. So you could say peer to bank or peer to institution or peer to wealth fund or peer to West End fund. So it's P to institution, P to I maybe. And in a sense, they're a mortgage banker, which means that they're going to originate loans, put them on their own books, and they're going to use their line of credit or other relationships to bring in the capital necessary to fund those loans. And you see the same at Zopa. Zopa is the first company to do peer-to-peer in the UK, and they basically are making the same exit. Future Bricks, I don't know as well, but effectively the model seems to be that retail investors are too much work. And I think this goes back to how these firms got licensed. The original license came from the OFT. The FCA didn't license or regulate direct consumer lending in this way. It was done by a different organization. So when those license holders were temporarily folded into the FCA with interim permission before they got their permanent permission, they were coming in with a different set of assumptions than the equity platforms. The equity platforms have always been in the FCA side. They've always had to regulate, scan, KYC, AML, the whole works, the retail investors. So I would argue that the peer-to-peer is coming up to the level that the equity platforms have had to operate at. Now, what's interesting in Crowd Property is they are still operating Crowd Property. They're still a peer to institution lender. The CP Finance is actually a separate entity, as they said, though it's related. It's a mezzanine lender. So they're going to have two offerings, two companies. Your direct first charge lender, your mezzanine lender, which can be at a slightly higher designation or second charge, third charge, whatever is appropriate in the situation.
And in terms of some of the things you mentioned about that equity is at this level and peer-to-peer is now being brought up to this level. I mean, one of the big changes is in the appropriateness test. So those who join our platform, investors have to do the appropriateness test, series of questions that really just emphasize that investors understand the nature of capital being at risk, that the money is not liquid, and diversification being a good investment principle, et cetera, et cetera. Peer-to-peer platforms haven't had to do that before, whereas now that they're been asked to do that, and that is I'm not going to call it, it's not a barrier to entry, but it's absolutely a hurdle that has to be stepped over by investors now who want to go through the peer-to-peer route.
You're just overly polite British guy. They're not being asked to do it like it's discretionary. They either have to do it or they have to close to retail investors. They have to raise their standard. They have to stop with this light touch and move it up. Now, it's definitely my opinion, maybe not regulator, the FCA's opinion, my opinion, that essentially they're bringing the two into line. And I personally feel as a passive investor, when you fill out the KYC, the AML, the suitability test, you really understand you could lose all your money. Well, that's a number of those steps aren't really or hadn't been part of the peer-to-peer journey for an investor. And what they're finding is a lot of the retail investors don't understand. This is not as safe as savings. This is not on demand. You can't get your money back as quickly. One individual complained that he's using a platform. It's one of the non-property ones. And he thought he could get his money back when he wanted, and it's been 4 years now that he hasn't been able to get his money back. So there's definitely some expectations are misset between the actual cash investors and the platforms hosting the loans.
Yeah, I mean, I think the point I was trying to make was it's not designed to be a barrier to entry, as in to prevent people. It's more designed that they have a more thoughtful process before they press the button to actually invest, which is probably a better way of putting it. So,
and if you look at where the big losses have come from, it's come from loans on peer-to-peer platforms or affiliated companies. Maybe not always the approved, authorized peer-to-peer platform. London Capital Finance is an example. And it's been on the debt side, and it's because the retail investors do not understand the risks that their capital could be lost. They think it's savings, and 8% is a great savings rate. Well, it's not a savings rate. It's a speculative investment.
Yeah, no, that's a very good point on that. So if you look at the peer-to-peer crowdfunding market currently, there's this increased regulation being foisted on the industry on the peer-to-peer side, bringing it in line, as John's arguing and pointing out very well, with what we already do in the equity side. There's then increased costs to the platforms in terms of implementation of this, which then obviously increases and squeezes margins and what is already a tight business model in terms of fees. And then you've got this increased scrutiny for financial promotions to retail restricted investors. So it's becoming harder, to market, to mass market, particularly to the retail investor. And then within that, you've also now in what is a pretty good market for lenders is increased competition from traditional lenders. So crowdfunding in some ways, John, is most advantageous when banks and lenders aren't lending, because then you've got an alternative. But where banks and bridging companies are lending and lending at good rates and lending with good sort of fee structures, well, then that also squeezes the peer-to-peer side because there are other alternatives.
It does, and I've advocated this point for a long time. I don't think there's ever been a good reason to be in the peer-to-peer space, because it is essentially just competing with the other lenders. Your cost of capital is not necessarily any lower. In fact, it could be argued with fractional reserve banking, your cost of capital is much higher than the institutional banks, the firms. So it's a very competitive dog-eat-dog world, where the peer-to-peer platforms have an advantage over the banks is they probably have a slightly cleaner, fresher, newer, lighter back office computer system, but you can only grow so big off the back of some IT savings. It's a very competitive lending market. As a borrower, I think it's great. Bring it on. You guys can knock each other out as far as I'm concerned when it comes to lowering what I'm going to have to pay you. But as a person who's trying to make money, I'd rather be in the deal, not in the loan.
Yeah, we'll take that a step further, not just as a borrower, but as an investor. Again, it's a good opportunity, but potentially to invest in property, again, in deals that you mightn't always get access to. If you're not a high net worth individual or an institution, peer-to-peer crowdfunding platforms do allow people to invest in those type of deals. So
I would argue they don't. And this I think there's one particular platform that I think misspoke heavily for years on this. No one who puts money into a peer-to-peer transaction is investing in the property. You are a lender. You have no stake in the property. Okay. You have no upside. If the property doubles in value, you see none of that. So I think there's particularly one platform that was way over the mark when they said, oh, diversify, invest in property. It's like bullshit. This is your lending, and you're going to get an interest rate if things go well, and that is it.
Mm-hmm. Yeah, no, that's actually a very good point. That's a well corrected on that, and that actually will lead into your Ask John question today. Actually, come to think of it,
which I haven't seen yet, so let's go.
I think we're almost there. In fact, so if there are any other questions, anyone wants to, or even other comments, please fire them up now, and Dal can certainly put them to John or myself as appropriate.
Yeah, and just follow on and sort of maybe promoting your platform slightly. If you want to invest in property, you have to go to an equity platform. You have to be a co-owner. You have to have a piece of the deal. You don't want to be a lender if you're trying to invest in the property and get some of the upside. capital is at risk. You can completely get wiped out with your investments, so invest prudently, but fundamentally never be a lender if you want to invest in property. Always be on the equity side, be a co-owner.
Yeah. So I see someone's raised a hand there. This is a live broadcast, so we don't open up the room to anybody just to come on and speak, but I'm more than welcome to put a comment into the Q&A. Everyone else can see the comment and then we can deal with it from there. So you're more welcome to do that. So before we pivot off, any questions come in, Dal?
Yes, so lending and investment, are you facing the downside risk of the deal and market sector?
Actually, to slightly correct you, Dal, he's saying lending is an investment.
Sorry.
As you are facing the downside risk. And I agree, the person raising the question, I agree with them quite clearly that when you lend money, you could lose your money. And that's actually in the consultation paper, that lending is a risk. My point is lending to a property person is not investing in real estate or in the deal. You're still just lending. It's an investment, yes, but you have no upside from how well the deal does. At best, you're going to get back what you were promised.
Yeah, I'm actually glad that person who's known to both of us actually made that comment. So I didn't want to sort of push back on you regarding that, being my elder and more senior experienced business person. But that is, in some ways, you can look at peer-to-peer as for the person making the money. Although it's a loan, it's still in their mind still an investment they're making, albeit in a loan structure.
Exactly, it's a fixed, it's a capped return investment. Yeah,
okay. Right. So you referred to London Capital, and there's obviously been some other sort of deals. Dolphin's been talked about, JVIP before. So maybe it's a good and actually it was actually Brenda made this question, wasn't me, but it was very appropriate. Can you explain the main differences between loan notes and peer-to-peer funding platforms, or a loan through a platform? I mean, is there a difference, or what are the differences in doing, let's say, a direct loan note with someone or doing a loan through a peer-to-peer platform?
So it's a little bit semantics. You could say they're all debentures. So they're all some sort of debt instrument. So therefore, they are largely regulated the same. Where you start to see some differences, in my opinion, is loan notes or industry jargon for a series of loans or a group of loans or a collection of loans that all have the same security or same charge on a property. So I borrow 100 from Dal, I borrow 200 from David, and I offer a security of a first charge on some asset, and it's effectively they're sharing that security, but they're making individual loans. Some people argue this is not a collective investment. Other people would argue it is. You could just ignore that under policy statement 2020-15. They pretty much have made clear that any debenture falls under their regulations as the FCA for promotional rules. And I would say that if you want to avoid possible contamination or possible legal problems with loan notes, use a peer-to-peer platform. And that allows you to have multiple investors making individual loans, all secured by the same security charge, and knowing that it's FCA compliant for promotion and it's FCA compliant for sort of the operation of the process. Loan notes are historically what happened in the past. They still exist. If you're investing over 100,000 in one loan, not everybody together, but you individually, then possibly you can be exempt from some of these regulations. But I would say you're playing at the sticky end of the process if you're trying to depend on loan notes. If you want to raise debt finance and you want to have multiple investors lending you money, go to a peer-to-peer platform, subject to being able to find one. It is a challenge, you know, and the FCA acknowledges that they're restricting the options because what they're finding is the people lending the money don't appreciate what's going on. Now, a general comment for anybody, whether peer-to-peer or loan notes, you need to have some very explicit risk warnings now in your document. The FCA is giving you the exact wording. In particular, you have to tell these people that this is not as safe as savings, that they can lose 100% of the money, but you have to use the wording the FCA has provided. It's in PS 2015 that came out in December of 2020. So this is an area that's fraught with regulatory problems. Again, there's no money in being your own compliance expert. It is best just to let this be outsourced to the platforms that know how to do this.
Okay, thank you for that. That's good, good clarity around that. Dal, any last one question before we move to wrap up?
Yes, so during all our trainings, we are advised to look for lenders and not investors who want to part of the equity. I prefer investors who are lending and not asking for equity. It's cleaner, easier, and don't want investors who have little knowledge of property getting involved with the equity side, because the economically changes and property prices fluctuate.
So I would argue that you've been trained poorly. Also, next time, put it in the Q&A. But you've been trained poorly and you actually don't understand how equity crowdfunding works. You don't have the problems that you're concerned about when you use a crowdfunding platform. So in particular, I would say go look at the equity crowdfunding platforms, Leo or others, and you'll realize that you won't have the problems of trying to corral a bunch of cats, all these investors. They don't get a vote in how you make your decisions about tiles and paint color and roofing and all this other stuff. So it's actually very fit for purpose for what your concerns are, but whoever's been training you is actually misinformed.
Okay, Dal, I'll say one more spin. We'll take this last one then if you want to just ask that one and I'll answer it.
Yeah, sure. Can we use the Leo platform as an alternative to traditional mortgage loan, i.e. raise finance for 24-month period and use funds to buy to let more property? The property will be in good condition at point of purchase, so no renovation required, and therefore this will not be a project.
Okay, so in some ways that's a yes and no answer. So the no part is that it can't replace a mortgage, because a mortgage is going to take a first legal charge of the property, and with equity there's no legal charges. The investors become shareholders in the SPV, so it's not a direct replacement for a mortgage or a loan in any way, shape or form. They're two different, it's apples and pears. However, in theory, could someone not take a mortgage out and raise 100% of money needed through equity? Well, the answer is yes. However, you need to look at the capital stack in terms of the ROI you offer to equity tends to be higher than offered to loans or debt, and therefore the commercials may not work if the equity portion is too big. So in theory, yes, you can raise all the money you need, but it would have to work commercially for you in terms of the ROI. It needs to be offered to investors because there is no security. Capital at risk, terms not guaranteed, and normally development type equity, you're looking in around about 20% per annum as a target ROI, which of course is significantly higher than a mortgage at going to be sort of single digits. So I hope that answers that. So
yeah,
have to move
I think,
on to
David, the twist on that is you can, for those that are religious inclined to not want debt, you can definitely use all equity, and you can set the rate of return that you're offering to be appropriate for the project. And investors like it, they like it. If they don't, they don't. It's a, you know, it's not a negotiation, but you can make your offer to make sense. I think your point is really good though. People have to look at, does the deal stack up? Will it make sense? And if it's not a development project, don't pay development rates, but can you attract investors at a different rate? And I know some investors are happy 5, 6, 7%, because that's what they're lending at. So if they're happy to lend it to you and they want to be a co-owner, then that could still work. So definitely talk to David and, you know, explain what you're trying to do. It may work really very well, or it may be a bridge too far.
Mm-hmm. I mean, interestingly, our income product that some fundraisers have brought us, while not replacing the mortgage, people have, if you like, sold equity for yield. So investors are effectively buying yield in an existing asset that's rented out. So there's maybe a hybrid there, certainly for a portion of the funds required. But we need to get to wrap up here. So Dal, just last couple of slides on what's happening with some of our projects. So how's Aldwick getting on?
Yeah, Old Wick. So project that we took on board, Bognor Regis town, West Sussex on the south coast. Very experienced fundraisers, T5. So this is our third project with us, with one which is already paid and one near complete. We've managed to raise 101,500. Due to the volume of interest from investors, we actually pulled it back due to the bank holiday weekend. Obviously, investors who were interested to help them to try and get the funds over, etc. So we actually pushed that now to Friday. So tomorrow at 5 p.m. it will be closing. We have reached our minimum amount. So if anyone is still interested, feel free to reach out with any questions that you may have. I can assist you further, or feel free to go onto the platform and make a pledge.
I have a question. So it says mixed use HMO, refurb, and rent as emergency housing. The investors aren't actually allowed to stay in during the rental phase, right?
Correct. The plan is that the investors exit at the point of when the refurb's finished. So yes, in this case, they're exiting.
Okay.
But the intention of the building is to become emergency housing.
Correct. Okay.
Yeah. Okay. That's a good one. And then Dal Wheats House. I know it's like literally we are so close to getting this view deal. Just explain this one quickly.
Yeah. Hopefully by next week, maybe by week or two, we should have this on the platform. Wheats House, Barham, Southeast Hampshire. This is now the fourth raise with Creation Tech. Very experienced fundraiser as well. It's currently a purpose-built 3-story detached office block, which is now looking to convert into resi. So 26 apartments is what Creation Tech are looking to do on this. And hopefully we'll have more about the project. Again, interested, feel free to reach out on this one as well.
Fantastic. Then we've got our YouTube channel, obviously. So encouraging people to subscribe. If you haven't already, please get on and subscribe, and you'll find a whole bunch of information. Lots of great topics, loads of the Ask John questions, all on our YouTube channel. So next week, I'm actually going to be on the road. I'm going to Bristol to look at some of our projects that are ongoing in the Bristol area. Meet with Ed and Miles from Beaumont, a couple other fundraisers, and some of our investors. So I'm going to be in Bristol. If I'm hoping to be on site in potentially Bridge Road, and I'll tune in live for a very short slot of our live broadcast. But the topic next week that John and Dal will be running is crowdfunding for passive investors. Crowdfunding for passive investors, and some of that leads on from what we talked about today. But really, John's going to share really what it is that he likes equity crowdfunding so much, being a passive investor, and what are the benefits of using a crowdfunding platform. And Dal, of course, deals with a lot of the investors on our platform, so it'll be a really good conversation around the benefits on that. So looking forward to that. And that is us for today. Last minute comments, John?
I think it'll be good to talk from the investor point of view next week, so I'm looking forward to that.
And Dal, anything else?
No, that's it from me. Thank you.
Fantastic. Hope you enjoyed today. Very beneficial. And
thanks everyone for your questions. That's always good to have questions live. So thank you.
Yeah. Fantastic, everyone. See you again next week. All the best. Bye-bye.